Gautam Duggad joins us. Let's connect with him and understand what he makes of the current market momentum, where there is value in the market, and from the house of MOSL, which is the next multi-bagger they will share with us. I think the third part is the most important part. I mean, I can start the interview with one question. Gautam, give us a list of three multi-baggers, and then we can end this discussion with one question itself, right?
Yeah, hi, good morning, Nikunj. I wish it was that simple.
You have a reputation what to do, my friend, that you give multi-bagger stocks. It's a good or a bad reputation to have, I don't know, but you have this reputation. So you should live up to your reputation.
Yeah, I definitely will try to in the course of the conversation.
Okay, so let's start. The markets have come up quite a bit from the recent low. Do you think the tariff risk have been abated or they could haunt us again?
So, Nikunj, it's a very fluid scenario, and I know I'm stating the obvious, but the situation is such that you cannot take a very long-term call on this unfolding tariff measures. You know, every alternate day you hear something different. So it will be very foolhardy to form a very rigid view on whether this thing is over or not. As an investor, all you can try and do is try to ensure that the damage to your portfolio is as low as possible. I know that's very difficult to do in this kind of an environment, but the macro situation of India is quite strong right now. You know, and with RBI also turning very supportive of the growth in the last 3-4 months, a lot of the pieces which had impacted our performance in FY25, and incidentally, we are coming to a close of FY25 with a very flattish year. In fact, the EPS has not moved much, 1 or 2% for FY25 and nifty. And in the last 2-3 months, you've seen the domestic macros turning a bit more supportive for growth. And in between came this whole global headwinds. Now, it's very easy to get swayed by what is happening around you, but there's very little you can do about it. So just hope that the damage to your portfolio is limited. The kind of exposure that you have in your portfolio, should be such that in the worst case, at least the relative damage from a sector point of view, from a bottoms-up point of view, should be as limited as possible. That's the approach we have taken in our portfolio while remaining cognizant to the risk which is emerging every alternate day on a new front. For now, we've seen that market has recouped the losses that stemmed post the 2nd April tariff announcements. And Nikunj, if you stretch back a little, we had already fallen before this whole tariff saga started unfolding. And obviously, one of the prime reasons for our fall was the sagging growth and a very muted corporate earnings. You know, last 4 years have been terrific. I mean, if you were told that 20 to 2024, you've seen a 25-26% earnings CAGR across all cohorts, it's very difficult to believe in today's environment. But that's how it panned out for the previous 4 years, and market rewarded that amply. Right? This is the first proper year of an earnings slowdown, first proper year of an earnings downgrade after 4 years. We had forgotten earnings downgrade from FY20 to FY24, and those earnings downgrade have started happening in FY25. So much so that whatever growth that we had penciled in a year back in April 24 for April 25, that is FY25, all of that growth has evaporated, and we are ending the year absolutely flattish. So we have to focus on two things. One is obviously the global risk, which every day we are hearing and reading about. But more importantly, when does India's own growth in corporate earnings start inflecting? Because that is what will decide the returns from here on. Once the noise around tariffs, the actions around tariff dies down after a couple of months.
If you wait for the robin, spring is going to be over, which is that you have to buy the bad news. Now, if you wait for the tariff war to get over, then you will not get these prices. Like they say in Hindi, na, कि भाव and भावना दोनों साथ नहीं चलते.
Yeah, good price and good news never come together. And today you have, compared to 6 months back, today at least you have an opportunity to do lot of individual bottom-up stock picking. You know, a couple of months back, I remember November or October when we did the conversation, and even in January, the valuations were such that even if your visibility on growth was strong, the kind of multiple that you are paying for, especially in mid caps and small cap, was way too high. Even today, the broader market remains very expensive despite the 15-20% correction that we have seen in the indices in September. Even today, Nikunj, the mid cap P for the NSE 100 is close to 28 times, which is at a 40% premium to Nifty 50. Your P on NSE small cap index is close to 21.5 times, again at a 10% premium to Nifty. The historical average is close to 20% discount. But the good thing is, especially in large caps, whether it is Nifty 50 or top 100 market cap companies of India, the valuations have now gone into a discount to long period average. So there are a lot of opportunities which are emerging in large caps, be it banks, be it IT, some of the consumption names, some of the industrial names. So you can think about constructing a portfolio today, provided your horizon extends beyond 1 year at least.
Yeah. Right. Gautam, seem to be getting a little bit of an audio issue with you. Just going to connect right back. I want to see what the market is up to till in the meantime. We're down about 83 points, so a little nervous ahead of the long weekend, ahead of some critical earnings. After Wipro, next is going to be Infosys. Remember, Infosys as well took a knock overnight, but like we were flagging off earlier, that Infy is actually going to give you the annual guidance, so that's going to be very, very critical. What they have to really say about the demand environment out there, because up until now, what you've heard from TCS and Wipro definitely doesn't augur well. But is all the bad news in the price is the question that you got to ask yourself when it comes to IT stocks, which of course is a different beat altogether. Other than that, Wipro, by the way, is now down 6.5%. There's Persistent also lower by 3.25%, and LTIM as well has taken a knock of about 4% or so. Other than that, of course, you've got ICICI Bank, you've got HDFC Bank, both due to report their numbers on Saturday. Tata Steel right now is lower by 2%. L&T as well is lower. There's M&M, Kotak Bank, Adani Ports, Jio Finance, Bajaj Finance. These are all stocks which are languishing. So a large part of the market, one would have to say, definitely is in the red. That slight bit of positive bias, that's largely with some of the leadership names like banks, namely ICICI Bank and HDFC. Other than that, of course, some of the pharma names and names like Bharti, which are also holding strong. As is the case with NBCC too, for a second consecutive day, that stock is holding up very, very smartly in trade. There's KEI, there's VBL, there's Muthoot Finance. These are all names which are holding very smartly in trade today. But Gautam, to your point about, this is indeed the first year that you are seeing an earnings correction or stalling, if you will, come in, and, the prices have gotten shaken off. But where do you think that earnings have actually bottomed out, and where is it that there is scope for a little bit of a beat at least?
So, Aisha, I would say instead of looking for a beat in this environment, it is better to look at sectors where you perhaps may not see incremental earnings cut. And that's how we have looked at while constructing our model portfolio. So, number one, I think financials, especially banks, do not have much downside. The expectations are very modest. In the last 6 years, in our coverage universe, the banking profits have gone up 6 times from 80,000 crores to close to 4,85,000 crores now. In fact, this used to be the total profit of our coverage universe of 300 stocks 5 years back. Today, that profit pool is accounting for only banks, right? And next year's expectation is close to 11% growth. So I wouldn't expect much downside there. Second, pharma. We've seen very consistent earnings on pharma for last 3 years now. And again, expectations are quite modest at about 12-13% growth. Third, automobiles. I know there is a global linkage for auto, but within auto, there are stocks which are very domestic focused too. And expectations for auto earnings next year is also 6 to 7%. Fourth, IT. I know it's in the midst of a storm and very risky to talk about IT given the kind of environment that we are in. But the expectations are hardly 7-8% earnings growth. Price damage, largely, in my view, is done. You will take few percentage point here and there. Very difficult to call out the bottom. But stocks are down 30% in the last 2 months. Many of the large cap storied IT names, the blue chip as you call it, today are trading at a discount to their 5-year averages and approaching their 10-year average P multiples pre-COVID. as Nikuj mentioned, you don't get good price and good news together. And last but not the least, I would think even consumer staples, there the possible downside on earnings is very limited now. Last year, if you look at the consumer companies, whether staples or discretionary, we had seen a bit of a moderation, especially in staples. We got -5% growth within Nifty for consumer names. This year, you have a bit of a support of price growth for consumer companies. And again, the expectations are very, very modest in consumer earnings growth at about 10%. So there are few sectors essentially with domestic tilt where the possible damage to earnings is limited. And in cases where there is a global linkage, like say IT, the price damage has been quite severe in the last couple of months. And potentially, maybe the incremental earnings cut, even if it were to happen, may not evoke a similar price damage now. So that's our view insofar as various sector and intersectoral mix of earnings is concerned. And that's what we've gone by while constructing our model portfolio this time.
Hi, Gautam. Good morning. This is Shrishti also joining in. Gautam, wanted to get your sense on the consumer pack because the consensus call right now that is coming is to stay with the discretionary plays while ignore the staples. Help us understand how are you analyzing the trend, and given the correction, where is your tilt in terms of your portfolio designing?
Yeah, so I agree with that view. We've been following that view for 4 years now. We've been underweight consumer staples for almost 4 years now. Our entire consumer weight in the model portfolio, save for one Hindustan Unilever, is allocated towards discretionary. Insofar as we are concerned, we have Titan, Trent, Indian Hotel, and Page in our model portfolio. The fact of the matter is, if you look at the last 5-10 year earnings growth of consumer staple companies, particularly, and when it comes to consumer, it's very important to even look at the top line growth. In last 10 years, you've not seen a single consumer staple company, barring maybe one or two, which is largely inorganic driven. They've not been able to report even a 10% compounding in top line growth. So consumer slowdown, while it has got a lot of visibility of late, especially in the last 1.5 year, but they've been slowing down for a decade now. If you look at 2014 to 2025 top line compounding. And we think that the penetration levels of many consumer staple categories have reached a stage from where the incremental growth will need a big push on premiumization, which in the current environment doesn't look feasible given the pressure on consumer wallets. So therefore, it is better to stay in categories where either the pricing power is high, or second, the room for penetration is quite high. So that's why we also continue to prefer discretionary, while also recognizing the fact that the recent correction in input prices do provide a short-term tactical trade opportunity in consumer staples, which is what you've been seeing in the last 1 month. There's been some rally in the beaten down names in staples, particularly owing to the fact that there has been a price correction in crude and some of the other linked commodity cost.
What is the thematic idea? For example, about a year and a half ago, you came out with a thematic idea on footwear. Then there was thematic idea on financial inclusion. Then there was thematic idea, I think, even on niche consumer companies, digital and all. Any thematic ideas which you can prompt our viewers?
So, Nikunj, one of the themes that we as a house have been betting on and have liked from a long-term point of view is the whole capital market linkage companies. And that's our report that we had put out in December with a coverage on 15 plus names. Now, I know this is a very volatile market, and therefore the short-term impact on the capital market names, including AMCs, wealth managers, exchanges, brokers, is going to be quite there, which is what we have seen in the results of some of the companies which have already come in. But over a 3 to 5 year period, if you have to bet in financials and you want to create an alpha, I would think the capital market basket should outperform by a margin over the next 3 to 5 years, because we do believe that the recent penetration that we have seen in DMAT, the kind of equity cult which has happened in the last 3-4 years post-COVID, it's not short-lived. There will definitely be bumps along the way. But as the investing profile of an average investor in the country shifts more and more towards equity, the room for a lot of these capital market companies is humongous. We have seen similar structural transformation 10 years back when insurance and NBFC started taking off. Job of a fund manager 15 years back, when it came to investing in financials, was quite relatively simpler. Now, when you look back in hindsight, you had to decide between private and PSU banks. Then after some time, you had to decide between banks and NBFCs. Then later on between bank, NBFC, and insurance, and so on and so forth. So today you have to decide between banks, NBFC non-lending, and capital market. And I think our own coverage is a testament to that. 10, 15 years back, we used to cover hardly 15 or 20 financial names. Today, we cover close to 65 financial names in an overall coverage of 310 stocks.
Now the first question, it could be the last question. Out of what we've discussed, 1, 2, 3, multi-bagger ideas. Multi-bagger does not mean they have to go up 10 times. Multi-bagger in your definition would be classic compounders, 15 to 18%, where you see earnings visibility for 5 to 7 years. If that happens, multi-bagger वैसे ही बन गया.
Yeah, so Nikunj, multi-baggers are always known in hindsight, as we all have learned over the years. I would think sectors like, consumer discretionary and some of the names I mentioned, which are there in our model portfolio, they have a room to compound earnings anywhere between 15 to 20% over the next 5 to 10 years, be it in jewelry, be it in apparel, be it in some of the other emerging lifestyle categories. Second, the point that I just spoke about, capital markets. Those companies have one of the essential points for a multi-bagger to happen is the starting point of market cap should be reasonably low. And that's what we got in capital market today. Third, I think this is a space which has recently got a good leg up is EMS. And that's where India stars are quite well aligned from a long-term point of view. I know they're quite expensive. They've had a fabulous run in the last 2-3 years. Some of them have already become 3x, 5x, 10x. Maybe there could be some lull there in terms of the near-term performance, but the long-term opportunity in some of those PLI-oriented names in the EMS categories is just phenomenal. I think I wouldn't be surprised if you see a couple of multi-baggers emerge from there, even from current prices over the next 3 to 5 years.
Really appreciate your time. Thank you very much for joining us, and good to have you back on ET Now.
Thank you. Thank you.